So there's a couple things that I encourage you to do as well. Make sure you email Sam Ebling, my internal, because several of the illustrations that we walk through today, the examples, he can actually send you the illustration that matches that. So I encourage you to reach out and we can get you those hypotheticals. But more importantly, those 3 to 5 names that you're thinking about, have Sam and the Crump Solutions team run you actual illustrations and we can work through those together so you can make the best recommendation. I do have an announcement. We are talking about California exclusively. And in the state of California, we still have our previous generation of product on the market. In all the other states that we do business in, we have our most current generation of product. But I want to make the announcement that we will be changing the premiums. So the premiums will be going up on the continuation of benefit rider charges on the policy. Now, if this is your first time hearing about OneAmerica, that's okay. You'll understand how our product works in a couple minutes. But there is no better time than now to lock in a great product with a guaranteed premium. Because in the first quarter of 2020, we will be having a rate change on the exact same product that you're going to see today. So product isn't changing, but the price will be on the rider charges. All right, so let's get started in our discussion. And I'll tell you a little bit about OneAmerica as an organization. If you haven't heard of us before, we are domiciled out of Indianapolis, Indiana. So that's where our home base is. And some of you may have actually been to our OneAmerica Tower. You can see there on the screen. We are a financially fit company. We're A+ rated, 95 Comdex. We trace our roots as a company selling insurance all the way back to 1877. As far as the products today, we call them care solutions. It's long-term care products that are asset-based. OneAmerica was really the first product to market, the first company that brought out this product in 1988 called Asset Care. We have a patent on the product, so nobody else can do what we can do when it comes to 2 people on one contract. More about that in a few minutes, but just imagine a husband and wife, a traditional marriage. What about you could offer this to someone that is a domestic partnership? In other words, they're sharing living expenses, they love each other. How about same-sex relationships, civil unions? We can also offer this joint life contract. As far as the company goes, we are also a mutual company. Now, what does that mean to you? That means that we're owned by our policyholders. We're not owned publicly. We don't sell shares. We don't chase that quarterly earnings call, the penny of profit. And that's meaningful because we celebrate claims. In fact, in 2018, our 2019 numbers will be coming out soon. We celebrated paying out over $5.8 billion in claim. So the company is financially fit. We're an insurance company that celebrates those claims. All right, now let's transition into really the meat of what we're working with today, right? Long-term care, extended care. That's care that is beyond 90 days, after you get out of the hospital, after your health changed and you're no longer in that state of rehabilitation. That's really long-term care. It's the daily grind. But there's an impact, a significant and equal impact both on the family and the finances. For those of us on the line today that have gone through this, you know what I mean. And if you haven't, I encourage you to talk to other peers that you know that have, because it can change multiple generations of families and completely wreck the best thought out financial plan. So I've put together some of the best questions I've heard in the industry over 2 decades. And there are 3 that are focused on the family. And then there are 3 questions that are focused on the finances. Now, don't worry. You have handouts on the right-hand side of the presentation today. There are 3 of them. The first one is all of the slides that I am reviewing today. So there's a PDF there that you can download. And then there's 2 other handouts that are focused on the ineligibility requirements of our product. In other words, what aren't you eligible for if you have this medication or if you're over this weight? So make sure that you download the asset care and annuity care ineligible conditions handouts as well. We're going to end with underwriting, so we'll talk a lot more about underwriting at the end of the discussion. But to really round out these questions from a family and financial perspective, this is your ability to help the client understand this issue is real, and whether they have lots of money or they've worked really hard to garner the nest egg that they have right now, they can divest pretty quickly, and it also has that effect on the family. So use these questions if you like them. Now let's talk about the OneAmerica product, the asset-based long-term care advantages. There are really 4 of them that I want to call out to you. The first one, and this is important, we say that there are benefits no matter what the future holds for that policyholder. The first one is if you live a long life. Well, if you live a long life, there's a much higher chance that you're going to look left or right and rely on somebody else for your care. And you'll see just how powerful these policies are when it pays for a long-term care event. Quitting. In other words, if you decide that this policy isn't right for you down the road, there are cash value accumulation in this contract, equity, in other words, that you'd walk away with. It's like owning versus renting. So there is value if you do decide to walk away from the contract. And of course, if you pass away peacefully, never needing long-term care, it does have life insurance components, so it will pay out a tax-free death benefit. Number 2, guarantees. You will see in our policies that everything is guaranteed. The premiums are guaranteed, can't go up. Your cash value growth, that death benefit, the life insurance portion, and of course your cash surrender value is all guaranteed. It's whole life insurance. The third thing that I want to call out is joint coverage. That's 2 people, 1 policy. Remember I said OneAmerica is unique in the marketplace that you can put 2 people on 1 policy. Of course, we insure individuals, and we are very competitive in that space, but there are things that we can do with our policy with 2 people on 1 contract that no other carrier can. And remember, it's not just for married couples. It can be domestic partners or same-sex relationships. And last but not least, you'll hear me say this often today, but lifetime coverage option. It represents by far the largest volume of our sales. Over 80% of our sales have unlimited long-term care as that rider. And that really means that we can cover the extremes. Whether your client needs 30 days of care or 30 years of care, that policy would continue to pay each and every month they're claim eligible as long as they need care. No other carrier in the industry can say that. All right, so now let's conceptually look at how OneAmerica's products are built. So our Care Solutions products are really made of a part 1 and a part 2. I call it the timeline. You always work left to right. So you'll note on the screen that we have a base contract. And that base contract is a makeup of life insurance, which we call asset care, or an annuity that we call annuity care. So let me pause for just a minute, because even if you've heard the OneAmerica story before, or if this is your first time, by the time we're done today, you may be like, wow, that was great, but it seemed like a lot. I want you to just summarize this in your mind to say there's only 2 products that OneAmerica has. It's how do you pay for them is how it makes them different, or the variance of. So your first product is asset care, that's life insurance with long-term care, or you have annuity care, which is an annuity product with long-term care benefits. All right? So there's your base policy. Now look on the right. That's part 2. We call it the continuation of benefit rider. And that's where you can get an unlimited long-term care benefit out of this policy. So people say, well, how can you get unlimited because you have a life insurance policy worth a certain amount of death benefit? That's because if you look here, you have the first part of the policy, the second part of the policy. They are separate and distinct, which allows OneAmerica to provide unlimited benefits. So now that we have a baseline of understanding of part one, part two, you got to pay for it, right? I often say that these products aren't too good to be true. They're just too good to be free, right? So you have to pay for the premium or the contract. And here's how you do it. The base policy, you'll notice the funding there. These are the differences. You can pay for it with a single premium, some sort of recurring premium. Recurring simply means it could be an annual premium. It could be a limited pay type of a product, like a 10 pay or a 20 pay premium option. If we're looking at old annuities out in the marketplace, you could bring that old non-qualified annuity over into OneAmerica through an exchange, or you could also do an exchange 1035, it's often referred to, from an old cash value life insurance product into our base policy. And on the rider, how you fund that rider can also be a single premium lump sum or some sort of a recurring premium. Now, the one thing you'll see on here is that I didn't mention qualified money, 401k as an example, those qualified IRAs. You can actually do that too, but we're going to separate that, and I'm going to show you in a couple minutes how to do that efficiently. All right, so now that we have an understanding of how you build it from left to right, let's dive right into some examples. But we're going to focus on asset care for a few minutes. Now, remember, asset care is what? Life insurance and long-term care. So just put annuity care for aside, just a couple minutes here. Asset care. This is a very typical example. This is a single premium option, whether it's cash or a 1035 exchange, a transfer, it still works the same. And this is a joint policy, so two people, 61-year-old male and a 60-year-old female in our example. The first part of the contract, remember, that's the base. We're going to pay that premium in one lump sum, so a single premium coming from cash equivalent somewhere, and it buys a death benefit. So you can see here in this example, $125,000 of premium will buy a little over $226,000 of death benefit. So at its most simple form, it will pay out a death benefit upon the second death in this example, because there's two people on the policy. If there was one person on the policy, of course it would pay upon that first death. But your client really bought this coverage for long-term care, right? The death benefit is an, oh, by the way, most of the time it would pay me generally more than I put into the contract from a premium standpoint, and it allows it to be all guaranteed. But why your client really buys this is the ability to accelerate that death benefit for a living need, long-term care. So what we have here is a 3% acceleration. So if you took out your smartphone and you took 3% of that death benefit on the screen, you would come up with about $6,800 a month that it would pay out per person for long-term care. Now, simple math says 3% of the death benefit is going to last 33 months, right? Just a little over 33 months. So that $6,800 will pay out for one person or both people. Both people could be claiming, and they would each get $6,800 a month. It's a simple bucket of money concept. So that bucket of money, if one person needed care, would exhaust in 33 months. But what happens if two people need care at the same time? Let's agree, it'll exhaust in twice as fast. So about 16 and a half months, the death benefit would be gone. But remember, with OneAmerica, you have a part two to this contract. Part one has been exhausted, right? We exhausted that for long-term care. Now let's move over to the right. You see that continuation of benefit rider? It will pay out the same $6,800 a month per person for as long as they need care. There is no stopping point until the person is not claim eligible, which would either be they passed away or they got better, right? So again, whether it was 30 days or 30 years, the policy would continue to pay out and insulate the family and finances. But remember, I said it's not too good to be true, just too good to be free. You got to pay for that rider premium, right? So what kind of a value would you put on that ultimate peace of mind of unlimited long-term care? Well, for less than about a cell phone bill a month for this couple, $180 of premium, and remember that premium can't go up, they just secured unlimited long-term care benefits. That's a monthly income stream for long-term care to the tune of $6,800. That's well over $140,000 a year if both people need care. So now you've seen a very popular version of our single premium approach. There's also several different ways that you could do this. Here's another one. You could do a single premium and pay for both the base and the rider. So you have that client, they really like the OneAmerica concept, but they don't want an ongoing premium. They just don't want that expense, right, on a monthly basis. They have $125,000 they're willing to reallocate, right, repurpose for a long-term care need. You could simply take that $125,000 in this example, same couple, and you could provide a death benefit of over $173,000 and the same long-term care benefit in the base and the rider. That's 3% acceleration. It works just like our previous example. And so you'd be able to provide over $5,200 a month each. And doing the math, that's over $60,000 each, or if both people are needing care, $120,000 a year for care as long as they need it. Now, one thing you can do on these policies, I haven't shown you here, but you certainly can add what we call inflation protection. And that can happen on the rider in the state of California. So you could actually add 3 or 5% inflation. And what that simply means is that $5,200 here, as an example, on the rider, each and every year would have a higher amount. All right. So you'd continue to grow the amount that it would pay out on a monthly basis by 3 or 5%, which one you chose. Now, of course, you'd expect to pay more in that premium as well. All right. Now, let's look at our healthiest of competition in California. These numbers are updated as of January 1st. So this has all of the competition. If you were to take that $125,000, no extra premium, okay, this is paying everything in one lump sum. With OneAmerica, you would be able to get over $5,200 a month for long-term care, and it's unlimited, lifetime long-term care benefits. With the other carriers, you're 25% or less than OneAmerica on a monthly basis, and you're capped at 6 years per person. So if this is a true long-term care conversation and long-term care solve, if you were the client, where would you put your premium dollar? All right, now let's pick up the pace, and I'm going to show you another way to pay for asset care. And this is what we call the recurring premium approach. Remember, same product, just a different way to pay for it. So I chose to show you a younger set of clients. This is still, maybe it's a husband and wife. He's 55, she's 54. They're still working. Maybe they're still putting kids through college. They're in high earning years. They have good income. Maybe they don't have the assets to reallocate a large sum of money. But look here. For just a little over $5,100 annually, and that's total, not each, okay? So we're paying for the base, in this example, of a little over $4,100, and then over $1,000 to pay for the rider total, okay? We are able to secure $5,000 a month for long-term care each, and it's unlimited. Now, again, you'd pay a little bit more premium if you wanted to add inflation protection, and we certainly see that on a regular basis. But just imagine if you were this client, this age, and you think about your umbrella of long-term care coverage, the comprehensive coverage that you would hope to have by the time you need care, this is a great starting point because as you continue that building block approach, Maybe you have OneAmerica for this amount of coverage. Maybe you had a small group policy from work. You fast forward 10 years and maybe that inheritance came in, or the kids are out of college and you end up buying some sort of an acceleration of a life insurance policy, and you add all of these together over time, and now you have a really comprehensive plan. So why I wanted to show you this example is we see a lot of younger clients that simply pay as they go. Now, we underwrite this product all the way down to age 35 and still able to get that unlimited long-term care rider, and all the way up to age 80. All right? Now, we'll end with underwriting, but of course, you would expect that if you're younger and healthier, your life insurance leverage, in other words, the more life insurance you can get per premium dollar, would be higher, right? And we have table ratings where you get some of those preferred best rates, and certainly that plays to your advantage if you're younger. The other thing, too, that we see is that our products allow you to get tax deductions on the premium associated with the rider. So make sure you email Sam Ebling, my internal, and he can send you our tax guide that we publish every year that shows you how to get those deductions. I've spent the bulk of my career showing young, financially fit business owners how to get tax deductions on the front end and always tax-free long-term care benefits at claim time out of these policies. And I can show you as well. I'm happy to do trainings in your office or virtually if you want to do them for your team. So please reach out to your managers and have them reach out to us, and we'll be happy to schedule those. But when you talk about these type of contracts, the ability to still get tax deductions on the rider, you can even use HSA money as well. That is a game changer. It allows you to have a conversation with the client that adds more value because you're showing them ways to make this even more affordable than simply that monthly premium that they would pay. All right, so now let's, remember I said we're going to talk specifically about a way to use qualified money to pay for our products. So what we do is we use what is called a SPIA. Now, our name for it is Immediate Care SPIA, but it's just a single premium immediate annuity. That's what a SPIA is, right? So we use that SPIA as a funding vehicle. So that's where we take the money, trustee to trustee transfer over from the 401k in my example, put it into this SPIA, and then the SPIA pays for what you just saw, what we call that recurring premium asset care product. And it's pretty neat because not only are you doing the right thing for the client, because many of our clients are heavy in qualified money. They may not have, disposable cash or cash equivalents sitting there to be able to pay for this. They've worked really hard. Just take a simple sliver of that qualified money, put it into this OneAmerica SPIA. So this is OneAmerica's product. And then what happens is OneAmerica pays OneAmerica. So the income from the SPIA automatically pays for the asset care product. And what's neat for you as an agent is you actually get 2 sales and you get paid 2 commissions. Pretty neat, huh? So with our SPIA, we can go from age 50 to 90. There's different ways to set up the income options. What I will tell you, the most popular way to do this, folks, is to do what we call a limit pay, a bookend approach where you do a 10 pay or a 20 pay. So you set up the SPIA on a 10 pay period certain, and then you align that with a 10 pay asset care recurring premium concept. And we do that all with you and for you, okay? You don't have to worry about it. We'll help you there. And of course, you can use qualified money or non-qualified money. I'll tell you the bulk of our sales is the qualified money approach, just because on the non-qualified front, we can show you several other options there at OneAmerica. All right, but here's the really great reasons why people use our SPIA to fund our asset care. Why? That qualified money from someone who is uninsurable. Now, I'll pick on the husband for a minute. He worked outside the home. He's got $1 million 401k, but unfortunately, his health isn't really that great, right? He wouldn't qualify for our coverage. He loves his wife, and she really owns this issue of long-term care. We can use his qualified money to pay for her asset care product. Pretty neat. And of course, if he's healthy enough, we can do it for both of them. You have options because you could fund the entire asset care product, both the base and the rider. Remember part one, part two, or you could just fund the base or just the rider. And remember, there are several payment options, whether it be a 10 pay, 20 pay, or continuous pay. So please make sure you reach out to us. It's a great approach to planning for long-term care using qualified money. Now let's turn the corner, and we're going to focus for the next few minutes on annuity care. Remember, so we've just spent a few minutes talking about asset care, life insurance with long-term care. Now let's put our annuity hat on for a minute. It's an annuity-based contract with long-term care benefits. It's really one product. It's how you want to structure it, okay? But I want to just hit the highlight reel on the annuity industry. And this is pretty compelling. It's a big industry, right? $2+ trillion in the deferred space right now. That's what people own in annuities. And yet, new annuity sales are really low in comparison. You think about a $2 trillion industry and about $200 billion of sales, that's a small number, right? And the average person that buys that non-qualified annuity is in their early 50s. But here's the question. How many are going to pass away with that annuity in force? Or how many are actually going to ever utilize the income rider on that annuity? They're paying for it, right? Well, here's from a Gallup survey that was done of non-qualified annuity owners. 83% said that they intend to use the annuity to avoid being a burden on their family, the people that they love, right? And 73% intend to use that annuity only if the sky is falling. And what we mean is some catastrophic event, an emergency, long-term care, nursing home cost, right? So when you think about what our products do, remember it's a value-based conversation and solution versus a performance-based. Now, what do I mean there? Value-based is your client isn't chasing a rate. They're not going from this bank to that bank and that bank all in the same afternoon looking for a smidgen of a higher interest rate because they're not looking for income out of the annuity. What they're looking for is the ability to get long-term care expenses paid with a lot more money than they actually put into the annuity. So let's show you how that works. One last thing, and this is, I call it the secret sauce. This is the reason why the annuity care products at OneAmerica are flying off the shelf. And it's because of the Pension Protection Act. Now, this law was fully legislated and enacted January 1st, 2010. So it's been on the books 10 years, a whole decade, and yet it's the best kept secret. So here's what's going on. You have existing non-qualified annuities out there, $2 trillion industry, right? Those annuities, by and large, have gain in them. In other words, they have grown bigger than what the client wrote a check out to put into the contract. So maybe their $100,000 that they put in 15 years ago is now $150,000. That difference is called gain, right? So your basis, your cost basis is what you wrote the check out to the company. But the gain is what has grown over time. So if you had that old annuity in your portfolio, and heaven forbid you needed care and had to write a check out to a care provider, you had to liquidate the annuity. Who gets paid first? In other words, does the gain come out of the contract or the cost basis? And you know, right? It's the gain. So Uncle Sam, the federal government gets paid their tax revenue before you get your check so you can pass it on to the care provider. Imagine if you could move that old annuity into a new type of an annuity called annuity care, and if you need to use that annuity for a long-term care event, you will never pay tax on it. Not one penny. OneAmerica calls that tax deferred to tax free for LTC. Tax deferred to tax free for LTC. Remember, that's what 73% of people said they're going to use their annuity for anyway, is that emergency, that rainy day for a long-term care event. But wait, there's more. I sound like an infomercial here, right? There's more, because on top of the money that your client put in and any gain that would accrue in the annuity base, they can also get an optional continuation of benefit rider on the contract. You bet. All right. So now that you understand the Pension Protection Act, and by the way, if we aren't answering your questions by the end of our discussion today, Sam will be reaching out to you to answer them more specifically. We want to make sure that this is a good investment in your time and we get your questions answered. All right, so now let's talk about annuity care, and I'm going to give you a couple examples here, very popular examples. This first product concept, we call it annuity care. We've had this around, selling it for well over 2 decades. But here's how it works. You notice it looks a lot like asset care, right? Base and rider. The rider's optional. You don't even have to sell it. By the way, I didn't tell you, on asset care, you don't have to sell the rider, but who wouldn't buy that unlimited benefit? The same thing goes with this. Most people we see will buy the rider if their health permits. But I'll show you when we talk about underwriting where even if you didn't purchase the rider, you're still doing the best thing for your client given their health situation. Because why? We just talked about it, right? The Pension Protection Act allows you to access your annuity tax-free for long-term care. That's a tremendous value in and of itself. All right, so on to this example. Remember part 1, right? That base, which is the fixed annuity in this example. We're going to put all of that $125,000 in my example. By the way, you can put a lot less or a lot more into these policies. So it's a single premium option only on the base. All right, whether it comes from old money in annuities or life insurance or cash, you can put it into that base policy. So there's your $125,000. We use that $125,000 as distributions over time, and it comes out, so about 3 years, you would be paid over $43,500 a year. So that's where this number comes from. All right, once we get an illustration, and by the way, Sam Ebling, my internal, has all these example illustrations ready to send out to you in email. So about $43,500 a year, you will get tax-free out of this contract should you become claim eligible. But wait, there's more, because after your money is gone right here, all tax-free, this 81-year-old female, she chose unlimited lifetime long-term care benefits, and she chose to pay a premium of about $300 a month for that ultimate peace of mind. Okay? So here's the question of the hour. What kind of interest rate or income rider would you have to find for this 81-year-old female where she could get $43,500 a year out of this product tax-free? The answer is about 35% is the interest rate you have to find for her. Because remember, once this policy is issued, she has access to that money should she become claim eligible. And by the way, it's unlimited. So $43,500 would pay as long as she needed care, not just for this period of time. It continues. There's another way to set up this product. We call it the packaged plan. So the same money, same client here. She says, you know what? I want to pay $125,000, move it from my left pocket to my right pocket, buy this concept, and we're going to put the majority of that, in this case, over $102,000 into the annuity, and we're going to pay for the rider all in a single premium. All right? You can do that too. And guess what we're going to get? $36,000 a year for long-term care, and it's lifetime benefits. So the same question is, you would have to find some sort of an annuity with an income rider that would be 29% or more to get the same amount of benefits per year out of this. So that's what we call annuity care. There's a next generation of annuity care that's available in California, and we call annuity care too, right? This, if you're taking notes, please put an asterisk beside this. By the way, in the handout section, if you join the call a little bit late, there are 3 handouts. There's a PDF of all of the slides that I've shown you today. So you'll have those at your disposal. There's also 2 other handouts, the asset care and annuity care ineligibility conditions. That's more about underwriting, and we're going to go there in just a minute. But annuity care 2, if you have a notepad, just put an asterisk by this, because this is the only product that I'm going to tell you about today that you do not have the option for unlimited benefits. Okay? This is also the only product that I'm going to tell you about today that is bundled. In other words, your base and rider are hooked together. You can't unbolt them. Okay? But this is a very easy way for clients to understand how to leverage their money into multiples of their money. So watch this. Our annuity, look on the fixed annuity, your 70-year-old female in my example, she chooses to put $100,000 into it. This is a single premium product only. You never pay anything else, ever. There is no ongoing premium option. It's a single deposit only. Okay? So she puts in $100,000, and it will pay out over $4,100 a month for long-term care. Now, do the math on that. That's about $50,000 a year, right? But wait, there's more. Because remember, this annuity account will be exhausted in about 2 years, right? 24 months, because you took that money times the 50,000 times 2. There's your 100,000. It's done. But there's an option here that you can choose more leverage. We call it the continuation of benefit rider. It's just a matter of which rider you choose. Okay, you have to choose a rider. It's just which one in this example. So here, what you would do is you would choose a rider that's an additional 36 months. So 24 months plus 36 months, that's a total of 60 months. That's 5 years, okay? This money is OneAmerica's money. This money is your client's money. When it's paid out for long-term care, all tax-free. And of course, this money is all tax-free as well. So your client's $100,000 deposit turns into $250,000. And it can happen overnight if they need care, right? It would pay out the next day starting at that point. There's another option. So look, it's the same approach. Your client's $100,000 plus 72 months. So 24 months if they need care plus 72, that is 8 years, 96 months, or the total, the equivalent of $400,000 of long-term care benefit. And last but not least, there's one more option, even more leverage. So think about this, 2 years, that's 24 months of care it would pay out at $4,100 and change, plus an additional 9 years for the total of over $500,000 of long-term care benefits paid out. So a natural question here, folks, is why wouldn't everybody choose the most leverage? All right? Of course, it's human nature. Everybody, we're thinking about long-term care. Why wouldn't we? Well, it's not true. It's not too good to be true, just too good to be free, right? So through this monthly LTC charge, which OneAmerica does all behind the curtain, what we do is, in essence, we take off the growth of this policy. We take a sliver every month off the growth to pay for that leverage, the rider. And naturally, you would expect you'd have to pay more for this rider than you would for this rider, right? So that's where if your client wants to still see their account value, that accumulated value, maintain around $100,000 in these low interest rate environments that we live in right now, people would they would naturally go to some leverage. Or the most popular option we see out there is the middle of the road. Your client's 100,000 can be paid out at $50,000 a year for long-term care for 8 years, and that's this middle approach, okay? So I'll call it good, better, best as far as leverage. It's that simple. Remember I told you at the outset of our annuity conversation that this is value-based, not performance-based. I haven't mentioned a rate once because if you asked me this afternoon, I wouldn't even know what the rate is exactly because clients don't care about the rate. They care about, hey, I put in 100. If I need long-term care, 400,000 could change the lives of my kids and grandkids because they wouldn't have to divest nearly as much of my portfolio. That's where they're coming from. It's value-based. All right, so we have nailed it when it comes to annuity care, but I want to end our discussion today with underwriting because as neat as these products are that you've heard about for about 40 minutes now, if we weren't the most reasonable underwriter in the industry, you probably wouldn't do business with us. Now, you didn't hear me say we're going to be the quickest. We're not going to get you an offer in a day or two. But we will go to the end to try to get that offer to get an approval. And I'll explain how that works in just a couple minutes. But here's a laundry list of things that OneAmerica will consider for asset care or annuity care that other carriers will simply walk away from. A big one is diabetes type 1. We can make an offer on that. And of course, we're going to develop that case and work on it hard for you. But a lot of other carriers, if they hear diabetes type 1, they will walk away from it. Other things, another big one is stroke or TIA. After 6 months of recovery, there's a great chance we can make an offer. Cancer, 6 months, completion of that last treatment, if it's early onset, first diagnosis of cancer. Combination type issues like diabetes with COPD, we could still make an offer most likely on annuity care. So now, focusing on asset care underwriting for a minute. With asset care, remember that's life insurance and long-term care. So there is morbidity and mortality risk at OneAmerica, living too long or dying too soon. With OneAmerica, though, about half of our applications, so if you submitted 100 applications this year with OneAmerica, about 50 of them, we would be able to do what's called express underwriting. And express underwriting simply means that with a phone interview, we're going to always pull an MIB report, that Medical Insurance Bureau, and we're going to get a prescription drug hit on the national database. When we have that information and we call your client, so through that phone interview, we're able to make a decision. So we're able to say yes or no, right? And then if we have to, which is the other half of the applications, we will move that to what we call traditional underwriting. And that simply means that we may need to get medical records from the doctor, we may need to get a paramed exam and a cognitive screen so that we can say yes. But remember, this is a good thing for your client because most likely they're going to get a no from other carriers that only do express underwriting. So set expectations with your client that, yes, it could take a few weeks or even a couple months before we get to an answer, but OneAmerica underwrites to approve. And here's how we can do that, is because with asset care, we can table rate your client all the way up to table 8. So from table 1 through table 4 is the same premium versus benefit dollar that you receive. If you're table 5 through 8, there's additional premium that would be charged. We also make a best offer, and what we mean by that is if for some reason we couldn't offer you asset care, but we still could offer annuity care, and I like to say it's table 9 and above, right? Because your client would get approved if they were table 8 or below for asset care. But if your client is table 9 or above, we could still make them an offer on annuity care. So now let's pivot to annuity care underwriting. This is different, folks. So there are no paramed exams. There are no medical record requests. We do an abbreviated 15 to 20-minute phone interview if you are purchasing the continuation of benefit rider. Remember, I told you on annuity care, there's only one product that you have to buy the rider, right? That's that second generation annuity. The first generation annuity, if you bought the base only, there is no phone interview. We simply underwrite via the application, the MIB report, and the drug or the prescription database. Because why? There is no mortality risk for OneAmerica. It's only the morbidity of your client. So applicants are either approved or declined, yes or no. No table ratings, no offers. It's either you are or you aren't. Okay? But here's a word of caution. You always want to be a good field underwriter. I encourage you, if your client has, their health is kind of on the fence, you want to engage our pre-underwriting inquiry team. That's our underwriters that can answer your questions for your client, because if you apply for asset care and we have to get medical records, the underwriters can't erase that information from their brain or our database, right? But if you did annuity care only, if you started at annuity care with a client that has health that's negligible, then we could make an offer and get an approval on annuity care for the same exact client that you may not get an offer if you started with asset care. So that's where the value of your wholesaling teams, your Crump and your OneAmerica wholesaling teams, our underwriting staff, can help you make better field underwriting decisions. Last but not least, we are asked a lot about height weight. And if you look, and this is where, again, make sure that you're downloading the handouts, both the presentation, that PDF of all the slides today, but the ineligibility conditions for asset care and annuity care. Look at this. Your client could be 5'10" and horizontally accomplished and weigh 324 pounds and still get an offer with OneAmerica. Now, if it's asset care, we would have to fully develop the case. In other words, get medical records. But on annuity care, remember, we never get medical records. So they still could weigh 5'10" and 324 pounds and could get an offer with us. All right, so with that, let's really summarize what we learned today, and I'll give you a few minutes of your day back. Think of your clients really from age 50 to age 85. We underwrite asset care up to age 80. We underwrite that annuity care product, the first generation product, up to age 85, second generation product up to age 80. But you could get clients up to age 85 an offer that they simply couldn't get anywhere else. Whether it's a couple or an individual. Remember, we talked about joint life, 2 people, 1 policy with asset care. I didn't tell you this, but on annuity care, you can also put 2 people on 1 contract. That is so neat. We call that an eligible person. So make sure you ask about that, because maybe the annuity is owned by her, but she loves her husband and she wants to put him on the annuity as an eligible person. We can do that at OneAmerica. Whether they have qualified money or liquid assets, remember, you heard that we can fund these policies with virtually any premium structure that you can come up with, from a monthly basis to a single lump sum on base and rider. Business owners, who doesn't like a tax deduction as a business owner? Anybody on the line, whether you're self-employed or you're an LLC or S corporation or even in a C corporation, you can use tax dollars to protect personal assets. So reach out to us, get a tax guide from Sam Ebling, my internal, and we can help you there. Old money, whether it's life insurance or annuities, you can transfer into our products, and we'll make sure that you're doing it the right way. But use that old life insurance, buy the new type of life insurance with long-term care benefits. And please revisit some of those old conversations you had. We say very respectfully that the only advisors that don't sell OneAmerica's products are the ones that don't know about us. So now you know, maybe you didn't know before today, but go back to those old conversations and say, hey, as your trusted insurance professional, I'm always seeking out the best products in the industry, and I just found out about this one. We need to have a conversation. So I'll end where I started. There's a team. There's actually two fully functioning teams. Your OneAmerica team, myself, Brian Shepard. I am your external wholesaler. So I'm out in the field. I want to work in your offices face to face with you. My internal, Sam Ebling, he sits at our tower in Indianapolis, our headquarters. So reach out to him by phone or email. Make sure you text income to 89800 and my contact information will pop up. Use our online calculator if you want to run some of your own illustrations. We have a phenomenal marketing website called assetbasedltc.com. And at the bottom there, remember I referenced access to our underwriters for pre-qualification? Simply email to the email address cspui@oneamerica.com. Remember, these handouts are available, so download them or shoot Sam an email, and he'll send you the slides from today. And last but not least, this is brought to you by Crump. And I'll make sure that Susan has a couple minutes to end the call. But Crump is your out brokerage partner. They are the resource that you need to lean on because they have tremendous tools and resources. Their wholesaling teams in the field and their solutions team are phenomenal, best in class. And that's why WFG and Transamerica Network partner with Crump, because there's nobody better out that. So with that, I really appreciate your business. We had a wonderful 2019 in sales, and 2020 is going to be even better. California is going to have a premium adjustment in the first quarter on the rider premium, so lock in those guaranteed